Welcome to Commercial Real Estate Now. I'm your host, Carly Iacono. Today, I am excited to be joined by Hue Chen, president of Saglo Companies. Hue, welcome to the show. How are you today?
Oh, it is a wonderful day. It's a nice summer day in South Florida. No complaints. Just
Rub
trying
it
to buy
in.
some shopping centers here.
That's always the challenge, right? Finding the good ones and getting out there. But I have no doubt that you're going to make that happen. And we're going to talk all about how today. So perfect lead in. Before we get into Saglo's retail strategy and how you handle your acquisitions, why don't we step back for just a moment and tell our listeners a little bit about the company and your role there?
Sure. Well, Saglo's been around for quite some time. It was actually founded in 1976. So this year marks our 50th anniversary, which is pretty.
Congratulations.
I
Big.
know. Look, that's a lot of down cycles. I feel like you measure a company through the down cycles that it's gone through, right? So
Right.
between the savings and loan crisis, the dot-com bust, the
Mhm.
9/11, the great financial crisis, and most recently COVID, and I'm sure there was other ones in between. Yeah, we're still here. We've never defaulted on anything, so we're doing well. We have a strong track record. We've been in retail shopping centers and neighborhood properties this entire, 50-year span. We're privately owned, we're vertically integrated. And I've personally been with Saglo for about 13, 14 years now, but I've been in commercial real estate for about 25 years.
Okay, so as president, I'm sure you have your hands in every bucket at Saglo, but what does your day-to-day look like at the company?
Sure. And actually earlier this year, I'm president and CEO. So I have the dual
Excuse me.
role for the time being. And as my executive coach always tells us that I'm always looking to replace myself. So I would happy to alleviate my president duties to somebody else at some point. But my day to day would be strategy, direction of the company, making sure I have the right people in the right seats doing the right things right at all times, quality control, and front facing with the investors, with our everybody in the capital stack, with our lenders. I speak with a lot of our vendors. Also, I touch base with all of our department heads, but I make sure that the machine is running well, and I do so through the department heads. And I want to make sure that we have the right leaders. There's a saying that a lot of people leave their jobs because of their boss. And I always want to make sure we have the right bosses in all of the departments.
You don't want to be the obstacle, that's for sure, right? So you want to facilitate those teams so everything flows smoothly and you can continue the growth for the next 50 years.
Yeah. And
That's
actually,
a good plan.
one of the more recent responsibilities has actually been the technology piece of it. And what I come to realize is that it's really important for the CEO, president, C-suite level to do that, because they're the only ones that kind of see the enterprise as a whole and across all departments. And the technologies today are going to redefine roles, meaning that what a department does right now is going to shift and evolve over the next 5 to 10 years. And I think that you have to see it, an enterprise as a whole, to understand what's the most efficient and the best tools to use to get the job done. Because if you had, let's say, delegated that just to someone in one department, they're only seeing it through the lens of leasing or property management or acquisitions, right? And they're not seeing how it can all be interrelated. And they are all interrelated, right?
For sure.
The basis that you buy your property and acquisitions directly affect your leasing, because they're going to have to, try to match a pro forma that the acquisition's created. And
Right.
then what you charge in CAM is property management, right? And then your general vacancy and your bad debt expense is accounting. So it is all
It all
related.
comes together for
That's right.
sure. So Saglo owns, I think you're over 2.5 million square feet now, right? If I've got that right. And you're across
Just
Florida.
just shy of two.
Just shy.
Yeah,
Okay.
yeah.
You're across Florida, Georgia, and Maryland, I believe. Talk to me
That's right.
about geography. You obviously started in Florida. What pulled you into the other states, and how are you looking at geography moving forward?
And the question's always, well, you only have so much time. Your infrastructure is so big. only so big, and just focus on closer. And I think that that's what we did. And we focused on Florida and expanded from Miami, where that's historically before I joined, we were only in Miami with one property in the Tampa market. We expanded throughout Florida, which would, Orlando, Jacksonville, et cetera. And then the next step would be to expand into Atlanta. And that was more thinking that, hey, there's these great neighborhoods in Atlanta as well, and all over the country. And the question is, there's just so much, how do you prioritize things? And we prioritize it through opportunities coming up. So if a great deal were to come up and it matched a neighborhood and community that we wanted to be in, then we're prioritizing that and looking at that right away. And that's kind of how we got into the Maryland market. There's a great deal that popped up, and it was a community that we thought was or is great. And so we pursued that. And that's how we're growing across the rest of the eastern part of the US. As opportunities come up and we really like those neighborhoods and communities, we're going to pursue it.
And I've heard that your target is, right, a stabilized shopping center with good fundamentals, but also with growth potential. So talk to me about what your ideal acquisition target would look like. And I don't want to hear any 20 caps in the heart of Atlanta. Like, we got to be a little realistic here. But what are you finding that's working, and what do those acquisitions look like that you're going after in today's market?
So we have a checklist, like most owner operators, and I won't go through the entire checklist, but I'll kind of give you some of the highlights of the way we're thinking about things and what we're looking at. A lot of it is story based, like meaning that, I'm asking, well, who owns it? Why are they selling it? How long have they owned it for? And the answers to that tells me quite a bit, actually. And sometimes it's pencils down. And the reason why is because, like, if you're buying from someone that's owned it for a year and they're essentially a flipper, the way that they approach CapEx and lease up and all of that is so different than someone that's owned it for 25 years or, wanting to retire, and they just want a good steward for their tenants for the next 20 years. I look at retail per capita. I want under retailed markets. So we do a lot of calculation and analysis to make sure that the number of square footage of retail per person is appropriate. We look at population trends. I want to see that the population is growing, but also that it'll continue to grow. So what are the employment drivers in the market? And is it a diverse industry? Because if I'm in a market that it's essentially one industry, then that's a lot of risk in itself. Like a lot of college towns, their education industry is driving everything. So if something ever happened to that, they're going to be in a little bit of a pickle. I look at crime statistics, places where, I would want to live myself. And then I look at the retail nodes. Where is the subject property compared to the retail nodes? And then the traffic patterns. Are you kind of on the way out of town, or are you on the way into town? Are you close to the interstate? Are you where the place used to be hot 15 years ago and it's moved away from you? I look at the price per square foot of the property versus housing prices around there. Meaning that, look, I've seen retail properties where you could buy it for 150 a square foot, but there might be $1 million houses right around there. So that just tells me that the underlying land itself is fairly valuable. So that if I was ever able to get out of all the leases, maybe it'd be worth more as land than it is as a shopping center. So that gives you some downside risk protection. I look at CapEx requirements and how that adds to the basis of your property, the tenant strength. And then just some of the technical stuff, the CAGR, the placer, the sales report, leasability, diversification of the rental income streams. Like if I have all the rental income coming from one tenant, that's like 70% of the property, there's risk in that. And, just the basic fundamentals of how a shopping center is laid out, the configuration, parking, access, and competition.
And are you buying anything that's not grocery anchored, or are you really focused on just grocery anchored?
I know I get that question all the time. And I'd say the last two properties we bought were grocery anchored, but we're not focused on just grocery anchored. And in fact, as more people are focused on grocery anchored, we'll probably be focused less on it just because we want a certain yield, and more demand drives down the yield. So I love essential use, necessity, daily needs type of tenant mixes. And if it fits that box, I'm all for it.
And you mentioned retail per capita, which I think is interesting. Do you have a different number based on the income demographics in a market or characteristics of a market? Or are you just using one basic square footage per capita number across markets?
No, we do have some modifiers to that. So if the
Yeah.
retail per capita turns out to be fairly high, like for example, if it's in our Amelia Plaza property in Fernandina Beach, Florida, the retail per capita, I forget the exact number, but it might be 40 or something like that, where you want it 30 square feet or under. But then I look at, well, how many hotel rooms are in that market? There might be 10,000 hotel rooms or 5,000 hotel rooms, and that's a modifier. So I'll keep that in mind, thinking that, well, let's look at the occupancy levels of those hotels. What are they charging? And you can get a lot of that from Placer AI also on the hotel
Hmm.
data. And that tells me maybe it's higher just because the retail per capita is higher only because they are still servicing a big tourist population. So we do look at that. And, look, I think we also look at household income, in that if you take the number of households and the average household income and you multiply that, you have total household income. And you can also divide that by your total square footage of retail and have a household income dollar per square foot also. And that's an important factor.
I love all these different metrics, right? Because you can't just go by one, and every market tells a different story. So it's great that you have these modifiers as well. I'm sure it makes your underwriting process a little more tedious. I don't know if tedious is the right word, detailed, we'll say.
Look,
Perhaps
I
it
hope
takes a little longer, which is
I
a
hope
good thing, right? At the end of
I
the
hope
day.
a lot of technology people are
Yeah.
watching this right here, because I'm kind of letting you know the pain points. Right?
Right. We're laying out what needs to be solved. I know as you were going through the checklist, I'm like, I hope he has a solution to automate some of this, because it's a lot of different things to check. And they're separate, right? You're going to separate data sources, you're compiling this manually. It's a lot of work. Hopefully not for long. Right there with you. Talk to me about how you find deals that meet all of these criteria. I'm sure you have good broker relationships. Are you looking off market? How are you sourcing deals primarily?
Oh, I'll kind of give you the whole philosophy of it. Like, and my answers are never too short, so I apologize. So I like brokered deals. I mean, that number one. And the reason why I like brokered deals is because all the data is been compiled, and it makes it really efficient to just underwrite the property. They usually have an Argus, they have historical P&Ls, they have tenant lease abstracts, and they have a lot of data. They even know like how old the roof is, as something as simple as that. I
Right.
find that a lot of what you call off-market deals, the data is really hard to find, meaning that where a marketed deal, I'm just handed the data right there. It might take me weeks to extract all the information that I need for an off-market deal. And then the off-market deal sometimes is never truly off-market. And
Yeah.
oftentimes it's, hits the market like a week later.
Or
So
my favorite is when you see a big marketing blast that says off market. And I'm like, I don't even know this person. Why am I getting this blast? Right. And I'm also a broker, and you're sending it to me as an off market deal. This is insane. But yeah, I think it's an overused term, but some are truly off market. And that's what we're talking about here.
yeah, truly off-market. So truly off-market, I'm looking at what they call, I guess, the 4Ds, right? The 4Ds are reasons, there's motivations for people that could sell their properties. The 4Ds are death, also including health issues. A
Mhm.
lot of times that there's a real motivation to unload the properties at that point. Divorce, dispute, partnership disputes, and then
Mhm.
dissolution. Dissolution meaning that you're just dissolving the entity because it's the end of the fund life, it's the debt's coming due, things like that. And so the question would be, a lot of this stuff isn't advertised broadly. I mean, and for good reason. But who would know of these motivations? And you have to really tap your network. And I think that a lot of attorneys, bankers, accountants, and if you're in executive networks, you're going to, uncover some of these landlords and property owners that may have a real motivation to sell. So we try to keep our fingers in the mix there. And just let people know top of mind, Saglo's looking to buy property. So they think of us when they hear of something like that.
It's great. They're not easy to find, like you said. So tapping that network is very effective, I'm sure. Talk to me about value add, right? So you're always looking for upside because you want a certain return in your properties. At what point do you decide true CapEx or renovation spend is warranted? Are you modeling higher rents or lease turnovers? Like, kind of what's the trigger where you say, you know what, we're willing to put some real money into this property acquisition?
It's a lot of leasing feedback. I have to understand
Okay.
the delta between if I renovated this property and by how much, how much more rent could I get? Sometimes the
Right.
market can't withstand higher rent. So then it may not make sense to add basis to the property by renovating it. But if it can, then we do a IRR analysis, a discounted cash flow analysis, and include that CapEx spend in those cash flow streams. A lot of times it's lender driven where I see if I can borrow the money for a large CapEx spend from the lender so I don't have to call capital. Or also I look at the competition. I mean, if we are not keeping up with the competition or hold back distributions to pay for it. And then if it's not on the front end, it's towards the back end. I look at the exit strategy and am I prepping it to sell, and does it make sense to invest that CapEx right before a sale?
Right. All makes sense. Good stuff.
Yeah.
So you mentioned capital calls, which kind of leads into my next question. Saglo is privately held. How does your capital stack come together? I know some of these answers through years of conversations with you, but tell me what that looks like with your investor base and how are you putting deals together?
I might need to defensively spend on CapEx, or otherwise we might lose tenants. So it's avoiding the negative, right? I look at life safety and risk, and also what are deferred maintenance items that if I don't do it now, it just costs 10 times more, 2 years from now. So I might as well just do it now. It's a better return on investment.
Capital side.
Yep. Our capital stack is you have debt and then you have equity. On the debt side, we borrow 65% of the purchase price typically. And we're borrowing mostly from banks and in some cases life companies, not CMBS though. We are allergic to CMBS. And on the equity side of it, over the last 10 to 12 years, we brought in friends and family investors to join us on the equity part of it. We are the lead investor and the largest investor. We're 25% of the equity. And we have many dozens of other investors make up the rest. So the next largest investor is about 3 to 5%. I have a lot of investors that are under 1% of the investment.
And are you doing a fund structure or are you putting the capital stack together on individual assets?
We are doing a fund structure now, but in the beginning, 10 to 12 years ago, we were doing it on individual assets.
And what made you switch to the fund structure?
It was really a diversity in risk, meaning that when you're in one asset, let's just say a major anchor leaves or a major tenant leaves, that can really affect your distributions. You might not see distributions for a year. And in a fund structure, while the highs and the lows are muted, it's unlikely that you're not going to receive any distributions at all in a fund structure because you have so many other tenants that are providing income to the fund.
And what seems to be most important to your friends and family investors now? Is it stability, given just some of the geopolitical turmoil? Is it growth? Are you competing with returns in the stock market, right? When you're trying to pull capital into the fund, like what really seems to be the main driver that investors are coming to you for what they're trying to solve?
The short answer, I have a short answer for this one. So the short answer is dividends, quarterly dividends. A lot of times they don't even read the reports.
Yep.
They don't have the dividend. Then they ask, hey, what happened? And I might have to say, well, Big Lots closed. It is a one property syndication, right? And communication, that's super important. But I also like to look at it in the framework of the ideal investment, in that a lot of people invest in retail properties and commercial real estate in general because it provides income. That's through the distributions. It provides depreciation. We do cost segregation because we hold it for a long term. And they enjoy the offsetting of income through the depreciation. the equity, and we're increasing their equity stake in that we're increasing the value of the property. And that's the A through appreciation, L being able to use positive leverage.
So they're looking for really stable income sources through distributions, but then also the other benefits that anyone who invests in real estate can enjoy: depreciation and sheltering of income. It sounds like it's a pretty standard profile. Okay, good stuff. Good stuff. And I'm sure you've had no trouble raising capital. Would you say the challenge is more on finding the assets or finding LPs that you want to work with, or both? Maybe both are going well.
No, I'd say it's harder to find the assets today than it is to find the capital. I think that once you've built a track record, it fairly, there's a momentum there. There's an inertia that keeps it going. But you don't want to raise too much money either. If you raise so much money that you can't deploy it responsibly, then that's also not good, because you tied up your investors' money for some length of time without without them being able to invest it.
It's a balance for sure. You need the money to perform on the new assets, but you need the new assets to get the investors. So I'm sure timing is always a little bit tricky in that scenario. Talk to me for a second about your employee, I think you call it stream model, profit sharing. How does that work? This isn't something I hear about a lot. So why did you set that up, and how does that work in practice?
Oh, Steam. All right. So the question that we asked ourselves as my partner, Jack, and I, was if the employees could get a piece of the GP distribution, is that a good thing? How would that work? And what would that mean? And what we ended up with was that we carved out 15% of the GP, starting with the latest fund, our 11th fund that started this year. And that's set aside to be distributed to all of our employees in a programmatic fashion as it builds up money into that, what we call, that's the Steam bucket. So that does a couple of things. Number one, it provides a aligned focus to make sure that we are focused on cash flow and on increasing value over the long term, because our funds last 10 years, maybe longer in some cases. And also it gives them ownership mentality and long-term thinking, because for you to continue to be able to distribute over the preferred return and to hit your IRRs, you have to think of it over the life of the fund, meaning even the CapEx investments and all of that. And also it shows to the employees that, look, it's not easy being a GP either, in that unless you're flipping properties and getting big pops every couple of years, which we're not, we're in it for 10 years or longer, for you to really get meaningful income as a GP is that you have to greatly enhance the cash flow and the value of each of the properties. So it gives our employee a piece of the upside, and hopefully it helps keep them with our company for a long period of time.
I think it's an amazing model. I wouldn't be surprised if you get a ton of calls after this episode of people wanting to come work with you, because just it makes all the sense in the world from both sides, right? You're incentivizing your employees to really be vested in the outcome of the asset in the center and the just profitable operation of it. But at the same time, you're helping them build a better life for themselves and build passive income. So they're helping you because you're helping them. And I think that's the ideal employer-employee situation that you don't see very often. So good job. How long have you had that program in place?
Well, it's just starting this year. We came up with the idea a year ago, and we said, well, it has to start with the next fund. So just recently.
Nice. Well, I'm sure everyone's very, very excited there. Let's move on to just a few points on retail overall before we wrap today. So we've heard, retail was dying, then the retail resurgence. Now it's, reinvigorated. There's been all these iterations of what retail is to be next. Where do you see community shopping centers going in the next 10 years? Obviously, you're bullish on the sector, but why? Why do you think it's going to continue to be relevant and grow as an industry?
So this was said many times at ICSC Las Vegas that we both went to couple months ago, or 1 month ago. I think that a lot of things kind of, the reason why things are often that trigger happens a long time ago, and there just simply hasn't been a lot of meaningful development of retail properties over the last 15 years, or ever since the great financial crisis, where before then retail square footage was growing at a clip of about 3% per year. Over the last 15 years, it's been growing at a clip of less than 1%, less than 0.5% actually. And since COVID, I think it's been growing at a clip of less than 1/4% per year. But the retail demand is still there. I mean, there's still, and the retail demand means population growth. The population's growing. That's aggregate demand. It's income growth. If the incomes are growing, that's also aggregate demand. I think that until you start to oversupply or build a lot of retail, I think it fundamentally is going to be strong.
And how do you look at tenant mix when it comes to demand and lack of supply? Are you feeling that demand will increase because there's so many categories of tenants who want to keep growing? Or are you kind of narrowing down what you think might be a good long-term concept and what might not? We don't have to call it specific tenants, but just by types of tenants. How do you look at that in your center?
Well, I think retail continues to evolve. And I want to make sure that the listeners know that retail, we're not only talking about Macy's and
Right.
TJ Maxx and things like that, but within retail, it's anything that would be in a retail property. So they often cite the 4 Fs, which is food, fun, fitness, and physician. So there's a lot of medical retail out there. That's anywhere from med spas to urgent cares to optometry to dentistry. There's a lot of fitness, tons of fitness now. The fun part of it's the experiential. There's the pickleball and the indoor entertainment things for the kids, and even Topgolf, right?
Right.
And then food, restaurants. Restaurants have really exploded, and you can even argue there might be too many restaurants today. So I think that you're going to see an ebb and flow there of the tenant mix, just as as consumer tastes change. But ultimately, the best execution of a tenant for a neighborhood and community shopping center is just to make sure that you really understand the community and neighborhood, what their needs are, and then best satisfy their needs through your retail property, and just make sure that your retail property, that community hub for that area.
Which comes back to that it really is a local business, right? Every community is different. And that's where all those factors that you mentioned at the beginning become so important to understanding the asset. It's not just who are the tenants and what's the address. It's all the different demographics, location, and traffic patterns, and are there hotels? And there's so much that goes into it to really understanding the market. All comes full circle. So tell me, what's next for Saglo? You're a privately held company. Do we have a big exit in the future? Are you going to continue to grow through new investors? What do the next 5 years, 10 years look like for Saglo?
We're going to remain privately held.
Okay.
We're not planning on an exit. We're not planning to go public. And what we're planning to do is just do what we've been doing: raise our funds, buy property, hold them for a long term, increase our portfolio size, and then keep good people at our company to just make operating these properties effortless.
Love that. Very succinct, positive. Seems like a good vision for the future. How can people find you if they'd like to learn more?
Oh, I'm on a lot of social media channels. I try to keep my branding up, so I'm on YouTube most recently, Hue Chen CRE on YouTube, and YouTube Music as its own kind of podcast feeling thing. LinkedIn's probably where I'm on the most. I think professionally, just those two.
Amazing. Well, Hugh, thank you so much for sharing kind of the inner workings of Saglo and how you've gotten to where you are today and what it looks like for the future. I thought it was very interesting, and I'm sure our listeners greatly appreciate your time as well. So thank you very much for being a guest today.
Carly, thank you for having me. This is great. So much fun. I appreciate it.
My pleasure. For everyone listening, that was this episode of Commercial Real Estate Now. We're so happy you tuned in, and we will see you again very soon. Have a great day, everyone. Take care.